So here I'm going to show you a description of how regular stocks, which just increase their dividends every year, fare compared to stocks that pay a higher dividend payout. Over here, let's say you start with year one at $1,000 and you invest in a mainstream company. They usually pay lower dividends between, say, 1% to 3 or 4% of their value each year, but they increase their dividends on a yearly basis, usually by about 5%, give or take. And here I see that it's not showing exactly 5%, so what I'm going to do is get these to show 3 decimals in that column for you guys. So as you can see, the dividends are increasing at 5% a year. So each year the dividends are getting higher and higher for your initial investment, and assuming you're reinvesting the dividends, it's still paying a 5% each year, considering the price of the stock generally goes up in value. Over here we start with $1,000 on year one, and you're getting a 10% return, but the dividend is not increasing. Now you have stocks that pay a higher percent return, and they're set up as trusts, so in essence they give at least 90% of their revenue to the shareholder. So unlike companies where the stock price grows in value each year and consequently they increase their dividends each year, this stock may not grow in value each year and the dividends don't change each year, but the dividends are a lot higher than regular for-profit or for-growth company. So here what I did was I took the first 30 years from this column here for the company that's designed to grow over here, and here is for the company that's set up as a trust. So here we have column O and column P. So here's the chart showing column O and column P. So after 30 years you can see how you get more than 4 times, I believe that's more than 4 times, more revenue each year or more profit from the dividends than you would with a company that tries to grow and raise their dividends every year. Now what we're going to do here is show you where we go for 60 years. You have the company which raises its dividend 5% a year, versus a company which pays 10% a year because it's set up as a trust. It pays a higher dividend, but it doesn't necessarily increase it. Now, trusts sometimes will increase them and sometimes will decrease, but I've noticed in the past few years the trusts that I've been trading have had their dividends fairly steady. Anyway, as you can see, you get to a point roughly about over here between 55 and 56 years, where eventually the company that has raised its dividend starts to outperform the companies that are set up as trusts. So as you can see, once it starts to outperform, it goes parabolic, a lot steeper than the trust would. So if you plan on living long enough and retiring, 60 years, so let's say you start working at 20 and you retire in 60 years, so by the time you're 80, and then you want to enjoy life, you might as well invest in a company that has lower dividends to start out, but they raise them every year. And if you want to retire sooner and get enough of a payout that you can live off, you want to get a trust and invest in those because they start out with a higher dividend, so you can actually make enough to retire in a short amount of time. So I hope this video was useful and helpful for everybody, and I hope you guys the best of luck in your investing endeavors. Thanks for watching.